please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Economic survey expects FY19 growth at 7 to 7.5%. So NewsRise, I guess, on that partly has got it bang on. But how does 7 to 7.5% look like?
Well, it looks modest, doesn't it? After all, this year was a down year. It is likely to be 6.7. In the first half of the year, for which we have concrete data, it is only 6%, 5.6 and 6.3 if you remember, Q1 and Q2. Q3 and Q4 numbers are still awaited, and the expectation is that it will top 7% in these two quarters. Even then, the average at best comes to 6.7. Yeah. So on a base of 6.7, 7 to 7.5 is modest. So nobody is expecting a runaway growth. You know, you've got many headwinds, many tailwinds. You've got a smaller base. You've got disruption behind you, so there should be logically a tailwind, and you've got some much better global growth. You know, every economy is firing at its best in 10 years and best in 11 years, and in the case of Japan, perhaps best in 20 years. So, you know, I'm wondering why we are not seeing slightly better numbers. For instance, Upasana just told us from Kotak Mahindra Bank that she wouldn't be surprised if the upper band is even 7.75. Looks like the CEA has been conservative in his estimates. Probably the GST disruption could take a little longer. Probably there has been disruption in the economy and we are not able to take advantage of the global growth immediately because supply chain has been disrupted. We really have to wait to see what Dr. Subramaniam has got to say on all these issues. At the moment, neither his Twitter handle nor the Finland's Twitter handle.
Some more lines have come through. Sure. One of the major concerns for the government remains the high oil prices. That was expected to some extent. They are expecting consumption demand to boost private investment. And they say that the biggest source of upside remains exports.
Okay. I mean, I would be glad if that hope pays off, because exports have not grown as well as imports have, and exports have not grown as well as other Southeast Asian exports have. I mean, Korea is actually, an economist was pointing out, Jim O'Neill actually, on our channel when he spoke to us last week, said that South Korea's exports are growing at the highest since they started printing export numbers, which means, like, you know, some kind of a 50-year high. So global trade has picked up, and we have not picked up commensurate with that. We are doing better than we did 8 months back, 9 months back. But the hope that exports will fire is a good hope, because GST disrupted supply lines and hopefully it will now be back in place. Demon also disrupted supply lines, and therefore the expectation that you know, maybe export will be the source of growth. We're still awaiting our guests. They will be joining us anytime now.
Lata, I think the press release is out. I'm just trying to download it. But amongst the other things, there is an expectation that the current account and fiscal position and growth could be impacted primarily because of the persistently high oil prices.
They're saying that employment, education, agriculture, that's going to be the focus areas in the medium term. That's in fact what the survey is saying. And in fact, in the official document, they're saying the real GDP growth to clock in at 6.75% this fiscal, Lata. That's what the official document is saying, and the economic survey predicts a 7 to
there's some sorry to interrupt you, Nigel. There's something coming through on GST. They say the resolution of the long-festering twin balance sheet problem by sending the major stressed companies for resolution under new Indian
and the IBC,
implementing a major recapitalization package to strengthen the public sector banks, further liberalization of FDI, and export uplift in global recovery. The economy began to accelerate. The survey points out that as per quarterly estimates, there's been a reversal of the declining trend of GDP growth in the second quarter of 2017-18, led by the industry sector. The GVA at constant basic prices is expected to grow at the rate of 6.1% in 2017-18, compared to 6.6% in 2016-17.
Come again? The GVA
is expected to grow at the rate of 6.1% in 17-18. Which compares with 6.6% in 16-17.
Okay, that's a way more modest assumption than what the CSO put out. The CSO, if I remember right, said that the GVA for the full year could grow. Okay, the CSO's estimate is 6.1. Right, GDP was 6.5. So we'll have to wait and see why the estimate. CSO is estimating a lower GVA than RBI's GVA. CSO had estimated only 6.5% in terms of GVA, so it was lower than RBI's forecast. But FY18 gross value added likely to grow only at 6.1. That means they are quite clearly underplaying the estimates for the current year, which I don't think is very bad news for the market, because after all, this year is now done up to January. We have only about 2 months left, so it's not going to be, and the third quarter numbers are coming in good. But I think that's had a slight modest impact on the Sensex itself. We saw a little bit of a negativity in the markets. Any further details, Sumaira?
I'll just read out some more paragraphs on the GST. They say there's been a 50% increase in the number of indirect taxpayers. There's been a large increase in voluntary registrations, especially by small enterprises, etc. The survey states that...
Actually, just a minute. The real GDP is still expected to clock 6.75. So that way, it's not very far from what the CSO said. The CSO also said 6.7. Yeah. So GDP-wise, it's not a very big difference. It's next year's GDP that we will look out for, and that at 7 to 7.5 is a little more modest than maybe many people would expect. So that's the main takeaway. Agri growth likely to be 2.1%.
Yeah, agri 2.1%, industry 4.4%, and services 8.3%.
Okay. 8.3%.
Yes.
Yeah, actually, I think even the CSO had said that manufacturing would be 4.9% or 4.6%, if I'm not mistaken. So I think they're basically telling you exactly what the CSO's estimates were. They've not given us a different estimate at all. So there you are. Agriculture is estimated at 2.1% by the CSO as well. Manufacturing was estimated at 4.6% by the CSO as well. These are repeat of the CSO's numbers. We don't have anything new in terms of last year's numbers. They have they've taken the CSO's estimates as the base case. We got those numbers on Jan 6th, if you remember. Okay, Upasana Bharadwaj is back with us. Upasana, we don't have much to tell you except that this year's growth is expected to be, next year's growth is expected to be between 7 and 7.5%. Is that beating down expectations?
Yes, Tata. Like I said earlier as well, I was expecting a 7 to 7.75% range, just to account for a possibility of a positive surprise. But I think, the CA has preferred to err a little on the conservative side. And hence retain the 7 to 7.5% range.
Okay. Well, I'm still looking for forecasts. There has been a lot in terms of, the year that was. The survey points that India can be rated as the best performing economies in the world, as the average growth during the last 3 years is around 4 percentage points higher than global growth and 3 percentage points higher than that of emerging market and developing economies. It points out that GDP growth has averaged 7.3%. In the last 3 years. Well, actually the survey, I can't now put my finger on that statement, but one of the big performing areas, Upasana, is expected to be exports. Is that hope well placed, that because of exports we should be able to fire up in FY19?
Exports is one of the factors, definitely. I think it's not just the global demand, but yes, I think, if you look at the entire scheme of things, the global recovery is happening in a very synchronized fashion at this point in time. And that has been supporting most of the export-driven economies quite a bit in the last 1 year or so. Of course, India could not participate in that because of its own domestic reasons. And I think now is the time when, most of our demon plus GST-related glitches are going to be gradually fading off. We should be, participating in that race. So, yes, to an extent, we would be definitely contributing positively from the export side. Okay. But to rely only on that would probably be... Okay. But of course,
no, that's not what he has said.
The way it would go.
Yeah, to be fair, that's not what they have said. They've just pointed out to red flags, saying that the survey has expressed concerns about growing protectionist tendencies in some countries, as well as the dampening effect that crude could have on Indian economy. However, with world growth likely to witness improvement in 2018, and he says moderate improvement, not gung-ho improvement, and expectation of greater stability in GST and recovery in investment because of ongoing structural reforms, we should be able to support higher growth. So exports is just one of the things that we are expecting to fire. Would you say this is largely your expected lines?
Yes, Lata, I don't think there's much surprise in these statements, because we know that we are on a cyclical recovery phase, and gradually all the sectors should be bouncing back, you know, after all the hiccups that we've seen in the last 1.5 years. So I think that phase is there. Of course, we're not expecting a V-shaped recovery, but somewhere a weak base effect is going to help the following year across all the sectors, you know. So that is there definitely. But I think oil remains the biggest point of concern for us, you know, the surging oil prices. And if we do not really see a halt in the upside to the oil prices, then, you know, of course, a significant amount of, you know, our pickup in growth, the upside probably could be shaven off. So we'll have to be really watchful on the oil price trajectory.
Okay. Well, then there are some warnings that have come. The survey highlights that policy vigilance will be necessary in the coming year, especially if oil prices remain elevated, high oil prices persist, or if elevated stock prices correct sharply, provoking a sudden stall in capital flows. So that's the first comment that's coming in terms of a possible shock from the international arena if oil prices persist and if elevated stock prices suddenly fall for whatever reason. Actually, we are now joined by Sajid Chinoy as well of JP Morgan, and Abik Barua of HDFC has joined us again. Sajid, welcome. This is the first warning that I want your comments on two things. The expectation of growth seems modest, coming from a low base. 7 to 7.5 is the GDP forecast. As well, the survey is highlighting possible macroeconomic concerns because of crude and if there is a sudden fall in global stock prices. Your thoughts?
I agree on both of those, actually. Our own forecast for next year is actually lower, at the lower end of that range. We're closer to 7.1 or 7.2. And I'll tell you quite simply why. Yes, you do have a favorable base effect. Yes, the disruptions from GST may well be behind us. Yes, global growth is stronger and you'll get some tailwinds from there. But don't forget the key word here, crude prices. If oil prices remain at $70 a barrel next fiscal, that is a 20% increase over the current fiscal. Our estimate is that this shaves off 40 to 50 basis points of headline growth immediately. Now, the economic survey was very honest 2 years ago when it attributed India's acceleration in FY16 to the quantum of almost 100 to 150 basis points because of oil. So now as oil moves the other way, we have to be equally honest about what it shaves off from growth. So think about next year's starting growth point being not 6.7, but more like 6.3 if oil remains where it is. To go from 6.3 to 7.2 or 7.3 is still a substantial acceleration. And I'll just make one last point on this front, Lata. Yes, we talk a lot about global exports, but remember, it's net exports that matter. Imports have been every bit, in fact, stronger than exports. So net exports have actually been a drag. If these trade deficits remain where they are, and you find that higher exports are being undone by higher imports, then there is also an implication for growth. Your second point on the risks, you couldn't agree more. We wrote a piece on this last week on how oil at $70 for the first time in about 5 years is creating some macroeconomic pressures in the economy. We're seeing it in the bond market, but I think the current account deficit is where I want to focus, that if oil remains at $70 a barrel, we forecast next year's current account to be $75 billion or 2.7% of GDP, which is typically higher than the sustainable level of 2.5%. So there are, clear risks on the horizon, and it's very good to know that the economic survey is highlighting those.
Okay. Well, we've got one statement coming in saying that the survey may not, the government may not proceed with fiscal consolidation. Pause in general government fiscal consolidation may not be ruled out in FY18. This is par for the course, you would say, Abik Barua? I mean, FY18, after all, we know that fiscal consolidation could be put on pause mode for obvious reasons? After all, he's not speaking about FY19, FY18.
Yes, and I think there is perhaps reason for him to make a case for some fiscal space, additional fiscal space this year, given the various sort of one-off disruptions that have plagued the economy. I don't think he's, as you mentioned, making a case for FY19 and not continuing on the path of fiscal consolidation, but I think he does have a point. It was a bit of an exceptional year. We had disruptions which would have affected headline growth and consequently revenue collections and so on. So because the full impact of the demonetization really played out this year, and you had the GST related disruptions. But I think if he's making a case for not going ahead with a sort of fiscal stance on fiscal consolidation going forward, then I think there might be a bit of a problem, because bond markets, as we noticed, are extremely skittish, repayments are high, and state borrowings might be very, very heavy going forward. Okay.
Well, actually now we can open the survey pages itself, and it is 7 to 7.5. Real GDP growth will reach 6.75 for the current year and rise to 7 to 7.5% in 18-19. So now I have the page in front of me. The agenda for the next year remains full: stabilizing the GST, completing the twin balance sheet actions, privatizing Air India, and staving off threats to macroeconomic stability. Clearly looking like at privatizing Air India, and that can mean a lot of money for the government. They also say that the GST Council offers a model technology of cooperative federalism, which can be applied to other policy reforms. Over the medium term, 3 areas of policy focus stand out: employment, finding jobs for young people; education, creating an educated, healthy labor force; and 3, agriculture, raising farm productivity. So looks like those will be the 3 things that the CEA wants the government to focus on. Anything you want to speak about this, Upasana? This is the first page, first chapter of the economic survey, the outlook page that I'm reading out from.
Yeah, there are 2 parts to it. I think first is, of course, the focus areas: the employment, education, and agriculture. Most of these 3 were largely on lines of what we have been expecting. The focus of the government is expected to be on the rural economy, the agricultural productivity, be it the farm incomes, the infrastructure. So I think all in all, we were expecting that the agriculture sector would be getting a boost. Apart from that, of course, employment, we know that there's been a lot of dismay around the increasing level of unemployment across various sectors, especially in the rural economy, the kind of distress that we're seeing. So again, this gets linked to the rural distress, and hence the emphasis on employment also. And education, definitely, I would say this is a key, variable which the government needs to focus on, because the quality of education and the fact that everyone in the country needs to get that kind of quality of education. We still are far way behind most of our peers when it comes to the quality of education. So we really need to focus on all of these adequately, and hence the emphasis is absolutely, I'm in sync with these kind of proposals that have been made in the economic survey.
Okay, well, actually we aren't getting much more. I mean, it's in terms of details, I'm not able to give you anything specific. Okay, increase in taxpayers post demonetization. It's a substantial increase, though. At first blush, there does seem to have been a substantial increase in the number of new taxpayers. What we have after November 2016. 10.1 million filers were added, compared to an average increase of 6.2 million in the preceding 6 years. So, we've got a substantial increase in the number of tax filers. This is the first box item which is on demonetization, and it looks like there have been more tax filers. Actually, gentlemen and Upasana, if you all can wait by, Shireen is actually in conversation with the Niti Aayog Vice Chairman, Rajiv Kumar. Shireen, over to you.
Well, thanks very much, guys. Yes, we do have the Vice Chairman of the Niti Aayog with us here. Mr. Kumar, thanks very much for joining us. We are still going through the fine print of the survey, sir, but I want to highlight to you one of the important statements that's come in from the economic survey. The Chief Economic Advisor in the survey says a pause in general government fiscal consolidation may not be ruled out in FY18. Now, this is something that you have been maintaining for a while now, sir, at the Niti Aayog, and you've believed that even if there were to be a slippage, it is not cause for concern. Now, the economic survey is very categorically stating, and for the benefit of our viewers, let me highlight that statement again. A pause in general government fiscal consolidation may not be ruled out in FY18. What should we expect in terms of the fiscal deficit number then, sir?
Well, I can't, I don't think a specific number can be given out at this stage, but I think the economic survey is quite right in saying that given the structural reform that have taken place in this, in the FY18, especially the GST, and therefore the uncertainty in revenue collections, but also the after effects of demonetization, the greater formalization of the economy, all of that, the fiscal deficit, targets could be paused, and there will be a slippage, but not much. I can't see it slipping very much, because the government has done a lot on disinvestment and other non-tax revenues.
Even if there is a slippage in FY18, sir, which is what most people are factoring in, what does this now mean as far as the goalpost for FY19 is concerned, more importantly, because that is what people are going to watch out for. So does the 3% target, you believe, for FY19, will that still hold, or are we likely to see a slippage and a move away from that as well for FY19 specifically?
The glide path could change, and therefore you might expect a slightly higher fiscal deficit target for FY19 as well, because after all, to bring it down from a higher FY18 level would be more difficult. But on the other hand, given that the indirect tax net has increased by about 40% as the economic survey points out, and the GST revenues are going to be very robust going forward, maybe the finance minister will decide that he will stick to the 3% target, because that's been the sort of trend in this government, which is to maintain fiscal prudence, and hopefully we will achieve that.
Okay, so you're hoping that they will stick with 3%, but you're not sure. Let me also put to you what we have seen now in terms of new tax filers. The survey says post-demonetization and the GST, the increase in new tax filers has been about 1.8 million, and that is expected to boost individual income tax collections as well. So do you believe that, especially as far as the indirect tax collection is concerned, because that is where the real concern has been, not so much on the direct tax side, we could now start to see an upward momentum as far as GST collections are concerned?
No, absolutely. Shireen, it has always taken every other country almost 2 years to stabilize a new GST regime. We have done very well to get a huge degree of stabilization already within the first 6 months. You know that the December numbers have been up already from a slight decline earlier, and I see that the GST numbers will be very robust going forward. In fact, I expect a significant increase, because a large number of sectors which have never ever been a part of the indirect tax net are now coming into it. There is this greater formalization of the economy. The MSMEs are getting into the tax net. So I think, yes, indirect tax revenues will increase. Along with that, also the direct tax revenues will increase, because the effect of the GST would also be that some of the professionals, etc., who have been charging, who've been outside the net, will also be brought into the net as a result of all the measures that have been taken. So tax revenues will be buoyant going forward.
Okay, tax revenues will be buoyant. I want to point out, sir, some areas of caution that the economic survey is throwing up. In the factors to be watched, the Chief Economic Advisor says high rising oil prices, sharp correction of stock prices, a sudden stall of capital flows should be some of the red flags to watch out for. Now, given the fact that we've seen such a significant upward movement in crude oil prices. In fact, most market experts now saying that 60 could in fact be the floor as far as crude prices are concerned. And across asset classes, specifically the stock markets globally as well as in India, we've seen such a sharp rally. How concerned would you be with the possibility and the warning that the economic survey throws up here on both these counts?
On the oil prices, I'm afraid we will have to take the pain, because it seems that the oil prices have risen much more than what we had expected. However, I believe that there might be some events coming up which may have driven this, so for example, the listing of very large oil companies, etc., which might have driven this sort of rally in oil prices. And if that happens, maybe the oil prices weaken afterwards. So we can't just take it for granted, that they will continue to be at $70, etc. But nonetheless, 60 should $60 per barrel is what we should be planning for. But that also means that our petroleum exports, their value will go up, and therefore we might have a bit of an export surge. So that's for the oil prices. Here, the government's attempts at reducing our dependence on oil imports by focusing on renewables as well as domestic energy supplies must be taken on board, because that's what the government has been trying to do. On the sudden stall of capital flows, I don't think that will happen. There will be some market correction, as is always the case. There might be some correction in the stock market prices because they are at high. But nonetheless, the sort of continued upward movement of our stocks and the inflow of both portfolio and direct foreign capital will, I think, continue, and we will not see a sudden stall because my guess is that even a slight hike in interest rates by the Fed and by the European countries, etc., will not affect the inflows into India because of our own buoyancy in growth and our better market conditions going forward.
Let me then ask you about the policy agenda, sir, because the economic survey very clearly suggests that the government must support agriculture, it must stabilize GST, it must finish the resolution plus recapitalization process, it must privatize Air India and head off macroeconomic pressures. This is the prescription that the economic survey has put forward. In the context of the budget, sir, the emphasis clearly is likely to be on being able to address the agrarian distress, the rural distress. What would your expectation be in terms of specifics beyond just higher allocation for schemes like the NREGS, etc.?
I think the budget may outline a different approach to agriculture, which is focused much more on raising farmers' incomes than raising outputs. The budget may also talk about a bigger holistic treatment of the agriculture sector to shift farmers from being producers of commodities to producers of agro products, and therefore greater value addition, and a shift to more high value crops within agriculture rather than stay with cereals, etc., as we have been doing in the past. Agriculture, also the credit to agriculture and to especially the farmers, that may also come up in the budget. But also the budget will emphasize, Shireen, a greater reform of the health and education sector, because they have been in the making. The two ministries have done a lot of work, and these reforms will be accompanied with higher allocations so that we can improve the health and education standards of our people, which also the economic survey points out need attention. Macro stability, I'm not sure what the survey is implying, because our current account deficit remains well within 1.8%. Our foreign exchange reserves are very high. Our inflation is at a record 3.3% CPI, and our food inflation is down to 1.2%. So I'm not sure what sort of threats the economic survey perceives, except, of course, for the harder oil prices. But it also tells you that the world trade growth is buoyant, and therefore our exports would, I think, do very well, and therefore our external sector must look much better going forward, which will drive our growth to higher than 7.5%, which is what the economic survey gives us the higher cap. I think this cap will be breached in Afghanistan.
Okay, I think we are getting pictures of Dr. Subramaniam, who will be attending the press conference at 1:30. There is a lot of data that's coming out both from the CEA's Twitter handle as well as the web page created by the CEA's office. Let me get more experts in. A. Prasanna, the chief economist at ICICI Securities primary dealer, joins us now. Well, Prasanna, I'm going to just read random statements that we are getting in the form of flashes. One statement that has come is that India's stock market boom is different from the US. Better profit expectation, large portfolio allocations away from gold and real estate into stocks, and higher interest rates warrant heightened vigilance. So actually cautioning you about the stock market boom. Any thoughts on this?
Well, I'm not qualified to answer on that. I would just say the CEA is more qualified to warn the markets.
Okay. Well, from what you have got of the survey so far, would you say that the survey has been a little conservative in its growth forecast, 7 to 7.5?
I think largely the market estimates or the market forecast would be in that range. Of course, most of us would be probably closer to the 7.5%. Yeah. So if you take the midpoint, it's slightly conservative relative to the consensus. But I think they have, of course, mentioned that exports could provide more of an upside to even this forecast.
Okay. Well, any other interesting data that you have picked out? I think most of them are in line with expectations. Current account deficit this year expected to be 1.5 to 2%. No surprises there?
No surprises. Probably, again, I think it'll be closer to 2%, and next year will be higher than 2%. But what caught my eye was, of course, not any data, but the commentary on fiscal deficits, basically when they're saying that pragmatically steering between extremes of consolidation and stimulus.
Okay.
Modest consolidation that credibly signals a return to the path of gradual but steady fiscal deficit reductions. Now, my problem with all these things is it's all just words. I still think we need some numbers, some kind of commitment, even if the FRBM, whatever the finalization of FRBM is still some way away. I think for the medium term or for the next 2 to 3 years, the government should commit. It can be a higher fiscal deficit, that doesn't matter, but it's better to give a number, an anchor to the markets and stick to that. I think what has been missing in the last 1 year is there is no anchor, and that is what has led to a lot of volatility in the bond market and in general to higher interest rates. Okay, well, the survey is not adding to or solving that dilemma for the market or the gloom for the bond markets. Abik, your thoughts? The survey continues to say that the budget should steer the middle ground between extremes of stimulus and consolidation. Is it giving you any hint at all about what the deficit might be?
Well, I think this is a line that the chief economic advisor has taken for a while, that we need more, fiscal space. But, given the way that the bond markets have reacted to any sign of, fiscal slippage, perhaps it's the uncertainty factor which has played more on its minds than the absolute magnitude. I think it would be somewhat prudent, at least for the central government, to signal fairly aggressive consolidation from this point onwards. There is tremendous uncertainty on the state front because we don't know how the farm loan waivers will be financed. Some states have additional limits. Some states have limits over 3.5% of GDP. These limits have not been fully sanctioned. So if all this comes through in terms of bond supplies, unless you have a radical increase in your foreign portfolio investor limits, which has its own macroeconomic risk, then you might see a huge spiraling of yields going forward. So I think, at least for the central government, signal strong fiscal consolidation. Okay. Well, we don't know. It's quite possible they would. After all, privatization of Air India and things like that can add to non-tax revenues hugely, like this year's HPCL ONGC deal did. So we don't know. The FM can still surprise us with a 3% fiscal deficit number. I wouldn't put that out of the radar of possibility at all. Okay, now we have some concrete statements perhaps in terms of outlook for the current year. One point that the survey is making is the re-acceleration of export growth to 13.6% in the third quarter of FY 2018 and the deceleration of import growth to 13.1%. Again, he's taking a 3-month average.
suggests that the demo and GST effects are receding, and service exports and private remittances have also started to rebound. Would you buy that argument, Sajid, that this conundrum that the world is growing but Indian exports did not keep in step is perhaps over? That's the hope the survey is giving.
I think qualitatively, Lata, I agree with it. We'll wait and see quantitatively how much that plays out. Remember, for the full year as a whole, net exports, the CSO estimates, will still shave off 120 basis points of growth. But I do agree with the survey that this is very much a year of two halves. In the first 2 quarters of the fiscal year, exports grossly underperformed, imports were surging in. We had hypothesized that supply chains at home had been disrupted and imports were replacing those disrupted supply chains. It seems like the economic survey has taken that same kind of reasoning, and in the last few months there's clearly some signs that these things are abating. Again, the question is, what is the quantum out here? Because as we were discussing earlier, if oil stays where it is, essentially what the survey is presuming is there's 100 basis points acceleration in growth after controlling for the oil effect. So net exports will have to increase dramatically next year. And let's wait and see if that happens. So far, those monthly trade deficits are still high, though admittedly a lot of those are price effects from higher oil prices. Once you deflate that, hopefully net exports will be less of a drag. So I think directionally the survey is right. Let's wait and see what quantums actually pan out in the coming quarters.
Okay. The other point that the survey is making is that post-demonetization, we have seen a 30% increase in new filers. But it also goes on to say that an overwhelming number of the new filers have declared an income of 2.5 lakhs, which does not bring them to the taxable limit. Any hints from there in terms of whether we should expect what kind of a direct tax forecast we should expect for FY19, Upasana? I mean, what would you go with? And with this statement, it looks like they should not be too daring in terms of a direct tax assumption. This year's is 17%, right, which is largely met.
Yes, I think, Lata, clearly, while there has been an increase in the new filers, for sure, which maybe over a period of time does suggest that direct tax collections will go higher, but not immediately in the FY19 year. So we are going with actually a 15% growth in the direct tax collections. And I think that kind of remains a fairly practical growth to go with. And maybe somewhere around those growth levels is what the government would also stick to.
Okay, I mean, I don't know how to read this sentence. I'll just throw this at you all, and then I think we should get into a break, because I would allow you all to read the survey yourselves, and maybe we can gather later in the evening and analyze the main points. Look at this sentence. Finally, an important factor explaining the growth recovery is fiscal, and he is referring to the current year, which is providing a boost to aggregate demand. For reasons related to smoothing the transition, GST revenues will be collected for only 11 months, which is akin to a tax cut for consumers. Meanwhile, overall revenue expenditure growth by the central government and state governments remains strong at 11.7% April to November. Cyclical conditions may also lead to lower tax and non-tax revenues, which act as an automatic stabilizer. What do you make of this, Abik?
I'm still trying to find it on this, but I'm not too sure. Clearly, he's saying that there has been a net expansion of the revenue deficit, and that sort of led to stimulus both from the central and state governments, and it has acted as some kind of. So I really would have to look at this a little more carefully before
I agree with you. Actually,
figure out what the sentence.
Well, I think we will have to leave it at that. Let's just get to Sapna Das, my colleague from Delhi, who has more details with her. We are just trying to rapidly read the survey. Sapna, over to you. Any further details?
the one point that I'd like to highlight, and we're just referring to the GST numbers, the survey, or rather the CA's take on GST is extremely positive. In fact, she has gone ahead and said that looking at the way the state revenues have actually grown during the current GST implementation, basically, they are more or less revenue neutral. And taking this forward, he has come back to the original recommendation made by the R&R committee, of which he was a part, and he has made a strong pitch that probably the R&R GST rate, should be preserved at 15 to 16%. So we're trying to give a hint that possibly starting next financial year, the headline GST rate should be coming down. In fact, made a kind of a reference to this on Saturday when he was talking in context of, after the numbers.
Expecting that they will lower rates, you're saying?
Possibly. That's the take. Or probably he's only talking about the salubrious effect already GST will have in terms of the overall tax rates, in terms of indirect taxes. Probably that's the take. And the second thing that is surprising is that he has not really given an inflation forecast. He's only spoken about the impact, the worrying impact of oil prices and how that can, lead to a kind of a sudden fall in capital inflows. But really no forecast there. So, that's a bit of a question mark.
Okay. Well, actually, there is a lot that he's speaking about. Even personal income tax, he points out, has increased from usually under 2% of GDP to now 2.3%, probably because of the demo effect and the GST effect. Well, there is a wealth of data. I think I'll do one thing. I'll leave it to my experts to go back and read up, what they see as the key points. Let me just wind up by taking one quick comment from each of you on whatever you heard from the survey so far and whatever you could rapidly read from the pink page of the economic survey, the web page. Any final thoughts, Sajid?
Well, just the point, Lata, you made, I think it's important to understand we should look at the fiscal impulse net of asset sales. So if it turns out that the government pauses on fiscal consolidation in FY18 and the deficit is 3.5 and 3.5 last year, but remember asset sales are stronger this year, then net of asset sales you see a fiscal expansion of 0.2%. If further I argue that I cyclically adjust this because growth is slowing, then the impact on aggregate demand this year from the fisc is even larger, which makes the growth slowdown this year even more puzzling in a strong global environment. Okay, that's not a very positive takeaway for preparing for the next year. Upasana, just a last few thoughts very quickly.
Yeah, clearly, I think one is, of course, the impact of the fiscal impulse, which Sajid just pointed out, and the following statement that was made on the fiscal consolidation pause. It's open to interpretation, of course. We'll have to wait for the 1st of February for the final outcome. But, definitely that suggests that the fiscal roadmap is going to be revised as we go forward. And we probably would not see a 3% target being announced for next year. Okay. We will have to leave it at that. We've more than eaten the lunch show as well. Abik, Upasana and Sajid, thank you very much for joining us. Prasanna as well, he joined us on the phone. Well, just to say that, there is a welter of information on the current year, but on the year FY19, the limited information that the survey has given us so far, and we have barely been able to read even one chapter, is that growth expectations should not fly off the handle. More likely to be 7 to 7.5%, and there could be problems because of high oil prices. Not much by way of hint over here, but I think the salutary impact statement they are making is that GST collections could be far better, and even the current year, according to the survey, the collections are robust for the first year of the introduction of this, reformative tax, revolutionary tax.